All right, this is Ubaid on behalf of V Electronics, and in this video, we're going to be talking about functions of central bank. Okay, now when it comes to your central bank, okay, we learned a lot about the central banks. We talked about monetary policies, we talked about money supply, we talked about federal funds rate and federal discount rate. Okay, and we also talked about how central banks in general they regulate other commercial banks. Okay, so starting with number one, let's talk about money supply. Now, when a central bank imposes a monetary policy, okay, during an inflation, what they do is they restrict the money supply. And the reason why they restrict the money supply is because they want to reduce inflation. If there is a lot of money being printed out, okay, and being circulated in the system, then it's not going to reduce inflation. As a result of which they have to restrict the amount of money that gets printed out in the system. Okay, this has to do with reducing or restricting money supply. And this would be during an inflation. Okay, now during a recession, okay, they want to print as much money as possible. The reason why is because they want to circulate money. Okay, they want to increase production. They want to let businesses and individuals borrow more money. As a result of which, they have to print more money. When they print more money in the system, okay, you will have more money being circulated in the system, as a result of which more people will buy and sell, more people will borrow from the banks, okay, and in terms of line of credit, personal loans, okay, mortgages, so on and so forth. Okay, so this has to do with money supply. The second function of your central bank is price stability. Now, when it comes to price stability, obviously your monetary policies do impact prices. Okay, when the central banks they impose a monetary policy and restrict money supply, when they raise the interest rates to control inflation, okay, businesses, okay, they don't borrow as much and they don't spend as much, just like individuals. Okay, as a result of which consumer demand goes down. And when consumer demand goes down, okay, your prices, they loosen up a bit. Okay, because the consumer demand is low, okay, the businesses, they have to sell at a lower price. Okay, because the product is no longer in demand, as a result of which, okay, the business has to bring down the price. Now, when the central bank, when they impose a monetary policy during a recession, it's the opposite. Okay, which basically means that when the central bank they loosen up the money supply, and when they reduce the interest rates during a recession, okay, businesses are able to borrow and spend more. Individuals, consumers, are able to borrow and spend more, as a result of which your consumer demand goes up. And whenever the consumer demand for a product goes up, we know from the laws of economics, from the principles of economics, okay, the money supply, okay, as well as the product supply grows. Okay, so suppliers are able to supply more as the price goes up. Okay, if consumers are able to buy more, if the demand goes up, okay, obviously the suppliers will be able to supply more. Okay, that has to do with price stability. Okay, this is how the monetary policies impact prices. Now, apart from that, you also have economic output, which has to do with production and employment goals. Okay, so production and employment goals. And this also ties into your monetary policy, because when the central banks, when they impose a monetary policy and when they loosen up their money supply, when they print more money, the production, okay, may go up as well, because now there's more money being circulated in the system. Okay, people are borrowing more. Okay, as a result of which, okay, people are spending more. Governments, okay, businesses are spending more. Governments are probably spending more on infrastructure as well, depending on where they get their money. If this is taxes that the governments get their money from, then obviously, as businesses and individuals spend more, they're paying more in taxes, as a result of which governments are able to spend more on infrastructure, such as transportation, hospitals, schools, so on and so forth. All right, so whenever the monetary policy, okay, when they are imposed during an inflation, okay, the production usually goes up, okay, as a byproduct. All right, so apart from that, okay, you also have employment goals, right? So when it comes to employment, obviously, as production goes up, businesses are able to employ more people. Okay, individuals have more jobs. Okay, as a result of which, obviously, there is more employment in the system. Okay, so this has to do with your economic production or output and employment goals. Now, apart from that, you also have regulating commercial banks. Okay, so regulation of commercial banks. We talked about federal funds rate. We talked about federal discount rate. Okay, federal funds rate has to do with the rate at which banks or commercial banks borrow from each other, and central banks to some extent control, okay, that federal funds rate. They also monitor and control the federal discount rate. Okay, we know that when banks are able to indefinitely borrow from the central bank using the federal discount rate, okay, they're able to borrow money and then sell that money in the market, or lend that money in the market to other commercial banks at a higher price indefinitely. Okay, as a result of which, what the central bank does, they raise the ceiling. Okay, anytime the federal funds rate go up, anytime the interest rates go up, okay, they raise the federal discount rate as well. Okay, as a reaction to your federal funds rate going up. So this has to do with regulation of commercial banks. So regulation of commercial banks. Now, apart from regulation of commercial banks, they also help stabilize the macroeconomy. All right, and they do so via monetary policies and by acting as a lender of last resort. So when commercial banks run out of money, okay, when they can't lend money to each other, let's say they don't have enough in reserves, okay, they're out of reserves or required reserves go up because of whatever reason, okay, or let's say they're trying to scale in size, okay, by increasing or bumping up their capacity to lend more money in terms of mortgages, loans, so on and so forth. So in that case, what's going to happen is, okay, the central bank will act as a lender of last resort in case the bank is going through a bankruptcy. Okay, so we're talking about a consumer proposal, for example. So central bank basically acts as an intermediary. They act as an organization that offers consumer proposals to your commercial banks. Okay, and the reason why they do this is because obviously the commercial banks don't have reserves. Okay, if they don't have money within their economic system, okay, what's going to happen is, okay, eventually they will go bankrupt. People will start withdrawing their money. Depositors will withdraw their money. And this is the source, this is the supply of money for the commercial banks. If depositors withdraw their money, central banks, they have to act as a lender resort because commercial banks do not have a source of money. All right, so that has to do with stabilizing the macroeconomy. All right, so stabilizing the macroeconomy. So stabilize macroeconomy. Apart from stabilizing the macroeconomy, another function of the central bank is to